If you need cash but you're sitting on a mortgage around 3%, the mistake is usually not the interest rate on the new money. It's the fact that one option touches only the cash you need, and the other option can reprice your entire mortgage. That's why a move that looks cleaner on paper can cost more every month and a lot more over time. By the end, you'll be able to compare a home equity line, a cash-out refinance, and doing nothing by looking at the few numbers that actually change the decision. Picture someone who bought a home a few years ago and locked a very low first mortgage. Now they need around $60,000 for a renovation, a roof, or a pile of higher rate debt they want to simplify. The first thought is usually simple: pull equity. The part that gets missed is this: not all equity borrowing touches your balance the same way. Here's what actually changes. A home equity line usually leaves the first mortgage alone. That means the old low rate stays where it is. The new borrowing sits on top, often with a variable rate and a smaller starting balance. A cash-out refinance works differently. It replaces the first mortgage with a brand new larger loan. So instead of borrowing $60,000 at today's rate, you may end up repricing hundreds of thousands at today's rate. That is the core fork. If someone has a $300,000 mortgage around 3%, and they need $60,000, a home equity line is mostly about the cost of the new $60,000. A cash-out refinance is about the cost of the full new balance, maybe $360,000 at a much higher rate than the one they already had. Same house, same need for cash, very different math. A common mistake is thinking the cleaner loan is the cheaper loan. It often isn't. Now, let's put numbers on it in a simple way. Say the existing mortgage balance is $300,000 at about 3%, with roughly 25 years left. The principal and interest payment on that old loan might be around $1,400 a month. Not exact, just ballpark. Now, imagine a cash-out refinance that turns that into a new $360,000 loan at around 6.5% for 30 years. The new monthly payment can jump hard, even before you think about closing costs. That's the first hidden rule. When you refinance for cash, you are not just pricing the new money, you're repricing the old cheap money too. Now, compare that with a home equity line. Keep the old mortgage payment where it is. Add a second payment tied only to the amount you draw. The catch is that the line can have a variable rate, an interest-only draw period, and a payment that changes later. So, the line usually protects the old mortgage, but it can introduce more payment uncertainty. This is where the obvious assumption fails. People often frame it as fixed equals safe and variable equals risky. So, refinance must be the more responsible option. But that skips the size of the balance being repriced. If the first mortgage is far below current rates, the bigger risk may be touching the whole loan, not taking variable exposure on a smaller piece. That doesn't make the home equity line automatically better. By itself, it's mostly structure. The better question is which risk you're actually being paid to take. If the cash need is temporary or staged, a line can fit better because you may only draw what you need when you need it. If the project is one big cost and the budget is stable, a refinance can feel simpler because there is one payment and one loan. But simplicity has a price if it wipes out a low first mortgage rate. Now, go back to the realistic scenario. Someone needs $60,000. There are three broad paths. One path is the home equity line. The upside is preserving the old mortgage. Another path is the cash-out refinance. The upside is one loan, one payment, and no separate line to manage. The third path is slower. Do part now, wait on part, or use a mix of cash flow and smaller borrowing. That can sound unsatisfying, but sometimes the cheapest move is reducing how much expensive new money gets added in the first place. Another reason this might not show up right away is that lenders and borrowers focus on the monthly payment, not the full trade-off. A refinance stretched over 30 years can make the payment look more manageable than the true cost suggests. So, the practical way to frame it is to separate three questions. What happens to the old mortgage? What happens to the new cash need? And how long do you expect to carry the new debt? That last part matters a lot. If the timeline is short, maybe a few years, the damage from repricing the full mortgage can be especially frustrating because you gave up a low rate but did not keep the new structure long enough to justify the reset. If the timeline is long and you want certainty above all else, the fixed payment of a refinance can still appeal to some people. Outcomes vary, but the trade-off should be clear before anyone signs. Once you see that, The next thing to check is the break between monthly relief and total cost. A lower monthly payment is not the same thing as a cheaper decision. A long term can make a payment look easier while keeping interest running for longer. A line of credit can look expensive because the rate is higher, but if it protects a very cheap first mortgage and the balance gets paid down faster, the total result can still be better. That's why the screen that matters is not just the quoted rate, it's the loan amount, payment, term, and whether the original mortgage survives. Here are 3 concrete signals to watch when you compare these options. First, watch the spread between your current first mortgage rate and the new rate being offered. The bigger that gap, the more expensive it usually is to disturb the old loan. If that gap is small, the refinance case gets stronger. If that gap is wide, preserving the first mortgage gets more valuable. Second, watch how much of your new payment is being driven by the amount you actually need versus the old balance being repriced. If most of the payment jump comes from replacing the old mortgage, that is a major tell. You are not just borrowing new cash, you are resetting old cheap debt. Third, watch the timeline rules on the new product. For a home equity line, that means when the draw period ends and whether the payment can rise later. For a refinance, that means closing costs, term length, and how long you'd need to keep the loan for the reset to make any sense. Now let's make this practical. If the cash need is urgent and payment stability matters more than total cost, one option some people consider is the refinance because the fixed structure can feel easier to live with. If the biggest priority is preserving a low first mortgage, the home equity line usually stays in the conversation much longer. If the project is optional or can be staged, the strongest move may be shrinking the borrowing need before choosing any loan at all. And if money's tight, stability comes first. A lot of people are in this spot. The goal is not to find a perfect answer. It's to avoid turning a $60,000 need into a $300,000 repricing problem. The next checkpoint is the paperwork. Put the current mortgage statement next to the new offer. Look at the existing balance, existing rate, years left. Proposed new balance, proposed rate, monthly payment, and fees. Then ask one simple question. Which part of this payment is attached to new money, and which part is attached to old money I was already carrying cheaply? That one question clears up a lot. Here's the quick checklist to run before you make the call. First, pull your current mortgage statement and circle the rate, remaining balance, and years left. That tells you how valuable your existing loan really is. Second, pull the new offer and highlight the new balance, the rate, the term, and all fees. If it is a cash-out refinance, ask how much of that new balance is old cheap debt being dragged into a more expensive loan. Third, if you are looking at a home equity line, check whether the rate is variable, whether the payment is interest only during the draw period, and what happens when repayment starts. The line that looks manageable now can change later. Fourth, decide based on your real variables, not the lender's cleanest pitch. Your timeline matters, your cash need matters, your tolerance for payment changes matters, and your willingness to pay the new balance down aggressively matters. And fifth, do not treat access to equity as the win by itself. The win is solving the cash need without destroying a low-rate mortgage that may be more valuable than it looks. So, if you're deciding between a home equity line and a cash-out refinance, do not start with which option sounds simpler. Start with this question. Am I borrowing against new need only, or am I accidentally repricing my entire mortgage to get that cash? That is usually where the expensive mistake begins. If this helped, subscribe to the Wealth Blueprint for more clear money breakdowns.